This has definitely been quite a difficult market for many of us market participants. I'm here to break it down and share with you why I'm not so concerned, and I'm actually, from this current level, quite bullish on well-chosen, fundamentally sound names and stocks. A couple important structural characteristics of the market that we're currently experiencing are certainly worthy of note. For example, today was quite a rout, quite a violently negative day. However, it was also the second largest day for options expiration in history. $1.3 trillion worth of stock options expiring today. We've mentioned the quad witching here, and you can look up what the quad witching is and its historical correlation for yourself. But it's historically a negative day or one that implies significant volatility. Today was not a quad witching. We didn't have options across the spectrum of derivatives contracts expiring today. Nonetheless, though, it had similar characteristics, being the second largest stock options expiry day of all history. Another important fact and characteristic to note is that this is the worst start, the worst month for the last hour of trading since 1987. Now, we're certainly in a very different period than 1987, and 1987 was a rather bear market. I'm not going to be surprised if there's some characteristics of a bear market, and I actually anticipated many of them, and we'll go over that in a second. But after a rather sharp decline in 1987, you had a market up 40% in 1990. Now, 3 years is a lot longer than we want to see, but you saw, after a decline, continued consistent growth. And that persisted for over 10 years until the 2000 bubble, of course, bursted. Many want to draw characteristics between the 2000 bubble and today. I think some of those comparisons are warranted and others are not. Let's start with what is warranted and what we actually saw being a correction here in this market. If you go to the first two videos of this year, January 3rd and January 4th, you will see in the first video, we said there were some certain characteristics that we expect to be consistent over the course of 2022, but not all of them. The characteristics we expected to be consistent were the rally in energy that day. Many stocks up 3%. What we didn't expect to be consistent was the mega cap tech climb, which occurred on that day. Mega cap tech was strong. The second day of 2022, January 4th, we saw energy stocks perform well yet again, but mega cap tech begin to have its slide. And we have seen that slide continue, and we've been calling for a mega cap tech correction for some time on this channel. While I call for a mega cap tech correction, I don't call for a mega cap tech obliteration. I don't think we're at that obliteration yet, but we're getting closer to it. An obliteration would be closer to 20%. We obviously saw that in Netflix. I have never owned Netflix. We're down 12% in Alphabet, something similar in Apple, something similar in Google. We're down quite a lot in these stocks. These stocks, albeit expensive, and I think they're expensive, and let me just mention why I think there's a correction. These stocks have benefited from bond yields being low, and I'm not talking about the cash flow. I'm talking about the flight to safety. When bond yields were low, they didn't really offer investment characteristics, but Apple is certainly a safe stock. So it took some of those flight to safety dollars. Now as bond yields rise, they can finally become safe havens and flights to safety again. So these mega cap techs won't be collecting all those dollars. However, they're not the same as the Cathie Woods, which are down the last year. And let's not forget, bond yields have been rising for about a year or more. They are down. Mega cap techs are not susceptible to the same bond yield move based on cash flows as the 10x growth stocks, because they offer the largest and most consistent and predictable cash flows in the S&P 500. These are not the mega cap tech stocks of the dot-com bubble. The dot-com bubble occurred because there was a massive amount of large companies whose valuations didn't translate to their earnings, or they had no earnings, or they had little earnings, and they were in a complete different world of valuation. While, yes, multiples have been stretched, valuations have been stretched, that has certainly occurred here, the tech world is completely different now than it was in 2000. We have a much more mature tech industry now. We have a tech industry that actually produces cash flows and massive profits. And they are the most consistent, profitable earners in the economy. So a catastrophic collapse in these companies that are so consistent with their cash flow, I think is virtually impossible. Do I think a correction is possible? Yes. And I've been saying that since they were at all-time highs. And I've been saying that since before they were at all-time highs. This is not news if you've been watching this channel. So I think this part of the market ends. The mega cap tech ends. And that is really what's causing a ton of pain. Lots of people own these stocks. Lots of large investors own these stocks. And they're feeling pain. And they don't want to feel pain. And they want to take profits and just lock them in. Lock in the profits. And that's causing a whole sell-off in the market. And that, among other forces, is coming into the market. So where can we find some relief? When can this end? I think it can end next week. And I think there's a good chance we have seen a bottom today. Obviously, I don't like calling bottoms. I have called bottoms in the past. They have not been exact to the day. Excuse me. If you go to my coronavirus downturn bottom, March 19th, so 2 trading days away. Not exact, but close enough. And I don't like calling bottoms, but I am feeling, given the structural, numerical options and last hour trading things I mentioned earlier, I'm seeing characteristics of a bottom. So what catalyst am I seeing next week that may provide some sort of stability in the market? Well, what is the catalyst that is causing all these stocks to sell off? It's the Fed. It's fear of a very hawkish and tightening Fed. We're getting hardcore rhetoric out of respected Wall Street players like Jamie Dimon calling for 6 to 7 rate hikes in the next year. While I certainly think the Fed will hike rates and they will begin to not ease at such a strong level, and I have been in the rising bond yield camp, I have to stick to the facts. And what I'm hearing out of Jerome Powell is not the same level of hawkishness, albeit it is hawkishness, that the market is currently reacting to. The market is currently reacting to a shortcut in the path to normalization of policy. Jamie Dimon is calling for 6 to 7 rate hikes this year. However, the words the Fed used, and they choose their words very carefully, was not a shortcut, was not a rapid tightening. It was a long road to normal. And it's not like the Fed just raises rates to raise rates. They have to consider other forces. There's a lot of international conflict going on right now. And there's a lot of countries around the world who are very reliant on the US dollar and who have a whole lot of US dollar denominated debt. And while the Fed, obviously, its mandate is not to prioritize other nations, they want economic stability. We don't want to have international economic instability in a time when we're seeing instability brewing. That's not helpful. So I think there are forces like foreign debt being paid in dollars that the Fed needs to consider because they want to maintain the US dollar as the world reserve currency. If people are blowing up, they're going to default and the US is going to lose its status as the world reserve currency. So there's a number of forces here, even Xi Jinping calling for the Fed not to raise rates, that I think will make the rate rising picture a little bit more dovish. And next week when the Fed talks, possibly provide a dovish surprise to the market. I think the market is basically anticipating maximum hawkishness that it can anticipate. And I actually think the Fed is going to come in somewhere closer to the dovish end of the spectrum, albeit hawkish, albeit they're going to tighten, albeit rates are going to rise. Not saying that's not going to occur. I'm saying they're not going to occur 6 to 7 times in the next year. I'm saying the very bearish situation is not going to happen. I'm not saying the Fed's going to remain in quantitative easing. Things can be somewhere in the middle, but that's still a surprise from the obvious hawkishness, fears, and expectations currently existing in the market. And that may provide some sort of stability and some sort of floor. And after double-digit declines in the NASDAQ and in mega cap tech, maybe it's time to start getting close to that floor. So we'll see what happens. We're keeping a close eye on things. That's today's video. And until next time, peace out.